Thanks, Iggy. So nothing earth shattering. This is actually a normal week. There's nothing, it's a normal week with open interest at all-time lows, basically, but which is not normal, Um, all right, so this is generally a normal week. And let me try and plow. I'm not in my caffeinated zone right now. Okay, so make a little room. Doing a lot of uhs today. That's not good. Okay, so here are the red rectangle. Those are the trading days in question. The purple rectangle are the 3 days that are not covered by the CFTC report. There's the report. There's Randy's stuff on the right. The red rectangle correlates. And you'll notice on the left-hand side, the red rectangle is 5 days, and the right-hand side, it's 4 days. That's because it was a shortened holiday week. So one of the days on the left is really just folded into the other day. So the right-hand side is the American days, which would mean American futures and American GLD. The left-hand side is just the spot market, which is open for all those days. So I want to go through those a little bit, very, very, hopefully very quickly, and say, here's the week. You start with the week. The week opened here. Why am I doing highlighting again? I don't want the highlighting. Nice. The week started here and ended here. So obviously it's an up week that finished unchanged, essentially. But we're going to look at it as, for this analysis, we want to look at it as an unchanged week because you're looking at open interest. On the week, open interest should have come down. On an unchanged week that moves and goes back to unchanged, it should have come down. And I know it did, but the option stuff is what I haven't looked at yet. All right, so here we go. On day one, you have yes.
Ben, sorry to interrupt. That big red candle, that big red candle on the Tuesday, that was option expiration on Comex that day.
Really?
Yeah.
That's actually helpful because the red candle was the pin. The red candle was the pin.
And this is keeping with this is like last 3 months selling into the last trading day of the month.
Yeah. We're gonna, you know what? There's a term that I want to bring up here. For people who don't understand options, I'm going to bring it up so you can understand options and why the last day of expiration matters a lot. Okay? Why it can matter a whole lot. And why it mattered this time. Thank you, Britt. All right, so here we go. That's helpful. That just explained a lot for me. I'm like, okay, we pinned. What happened is we pinned. So you tell me on this day, that's expiration day?
Yeah, that's correct.
Okay, good. So maybe I should only be looking at futures because they probably have the options separated but not dealt it out yet. You know what I mean? No, not everyone's going to get what I'm saying here, but Scott, you follow me? Here's my futures hedge, and here's my options, which are the opposite, and they haven't netted them out yet, so it looks a lot bigger than it is. You follow me? Maybe I'm wrong?
No, yeah. I mean, yeah. I mean, I just wanted to. I mean, we'll have to look at the data, but I just wanted to raise that.
No, that's okay. So maybe you haven't looked at it right. Exactly. So yeah, I'm a little bit ahead of you on this, but by no means do I know what's going on yet. All right, so let me just clean up my desk here, and we'll put that right in the middle. Okay, so here we go.
I think they technically closed at the end of day 6 at the close of New York was the 28th.
What do you mean close? What does close mean to you?
Like New York close, 4 p.m.
No. I mean, when you say they close, meaning the options expire, the options get netted out. I mean, it can mean a lot of different things.
It was the rollover on 28th, right?
Everyone who's not familiar, the reason I'm asking this is the more information I get, the more refined of an explanation I can give you for the open interest changes. If I don't get it, if we don't have refined information, I'm not talking about Brent, I'm talking about like the reports are very vague intentionally, intentionally or not, sloppy on purpose. And if we can pinpoint the moment that something happens when they change the accounting, then it makes it easier to interpret stuff. And another chat. Settlement close was 27th for the Comex. All right. Yeah, Leon, that's it. The problem, Leon, is I'm looking at it from gold or I'm looking at it from dollars. They're looking at it like from their currency doesn't buy what it should. They have debasement. They have inflation. Yeah, it's kind of screwed up. That's right. That's right. But they were also feeling cheated of upside. You can hear their own ideological propaganda. I'm not saying it's bad, it's propaganda. Like they were out there saying to me back then, they were saying, we feel like we're being kept down by the man. Like I heard a very socialist mindset that wanted upside. That's what I heard. I heard back then, I heard we should be doing better. We want to do better. They weren't mean. They were just like, the imperialism of the West makes it hard for us to achieve. And I'm like, okay. And it was just right around the end of COVID, and there was not right around the end, a little bit after the end of COVID, and there was still a signaling concept. The West's left was signaling, we feel really bad for you, and white people are bad, like that, all that stuff. Well, it's like they were saying what the left was saying, but they weren't being like such pussies about it. Excuse my French. So, yeah, exactly. All right. So, all right, let me do this. All right. So here we go. 5 days. So the first day seemed like a week. No. Day one is an up day. Day two is a down day. So these are both normal days or flavors of normal. This is a trend day higher. This is the day that we were off. So this day will be folded into this day on Randy's data. So Wednesday, Thursday, Friday, Monday, Tuesday. Okay, everyone see it so they can follow along? All right, so day one is an up day. 5,300 contracts get in. So fresh longs get in, a continuation of these 2 days. So far, normal. In fact, this is the fish hook. Remember, these 3 days become like a fish hook. I kind of stretch a little bit. That's the idea. And so it looks like we're off the lows, right, Randy? It looks like we're done. It looks like we're going to have another run, right? And that's the first day. And then the second day is an unchanged in volume, open interest, I should say. I'm sorry. Oh, I'm looking. I don't want to look at that. All right, fine. I want to look at this. All right. So the next day, open interest is down a little less than 1,000 contracts, and the market starts here, rallies, and finishes near its lows. So you have basically this is fresh money buying, fresh money buying, fresh money buying, and then somebody sells it and it's over, and the market drops. Okay. Do you see this? That's a big freaking seller because watch, funds start to get in. All right. It's going to go up. Open interest goes up, right? That's this day. 5,000 contracts. Boom. First day of the cycle, 5,300 contracts. Boom. Third day of the cycle. It sniffs this area and runs away from it the first time. Second time, goes right to it like a laser beam, stops again, right? You can actually make the case that it went above it. So the selling here is filled. Now you've got selling here. The next day, the market, really, this is 1 day, right? Okay, the next day, the market opens here and drops all day long. So this is a trend day low. It's actually pretty, this day completely undoes this day, right? And so look at what happens. All right, so I want to include this day in the math because it comes out to be like the right number mathematically. All right, so 5, 10. Oh, this is short covering. Wait, this is short covering? This day here? Am I reading that right? And these 2 days come in over here. See this? Am I reading that right? 1,500 contracts on this day here come in. This is where the short funds covered. Now it makes sense. Okay, so here we go. Funds get in, somebody's selling it. Funds, short covering rally goes to here. This must be near your expiration. Your expiration is in here. All right, this day is not a day, and this day market goes down. Okay, so I don't want to make up a story that I don't have to make up, right? So let's try and get this right. All right, so up 5,000, funds getting in. Down 1,000, funds getting out. Probably stopping out. This is short. Okay, now it makes sense. Short covering, capped, comes off, stops here, right? Goes back to unchanged, basically, a little bit below unchanged. Next day, the short covering comes back. Market finishes strong. Next 2 days, short covering comes off. All right, so here you have funds getting in, short covering, funds getting out. So funds getting in, short selling it on the way down. All right. Someone catching a knife, that's the fish hook concept. Funds start to get in, it starts to run. Shorts panic and cover, runs into a brick wall, and the market's lower. Somebody's selling here. Somebody bigger than your macro discretionary guys, I think. Anyway, I'm not sure. All right, so those are the 5 days here. And the last 3 days, so this is a big down day, right? 13,000 lots of open interest get out. All right. And this day, almost 8,000 get out. That's funds getting out, but it doesn't really drop a lot. This is the banks or the cover. This is the banks or the gamma buying again. And where's your 3,300s right there. There's your gamma trading. Okay. So this is people buying below the strike on gamma. This day, that's a very cool day, right? Open interest comes in again. I mean, look at this. This is what we were talking about, Randy, right? Open interest just comes in all the way here. So on each day, I can give you this happened or that happened, this happened or that happened. But really what you have is everyone's getting out. Shorts are covering, longs are puking. Shorts are covering, longs are puking. That's it. Everyone's just getting out, just not at the same time, right? Funds get in. Shorts cover, longs puke. What's this day here? First day? Longs puke. I'm sorry, this is continuation. Longs puke, right? So basically it's longs get in, shorts cover, longs puke. Longs puke. Jesus. Market dips and goes back up, shorts cover. Market dips. So everyone is losing money here, except for maybe these guys didn't lose money. Maybe they sold up here. So everyone seems to be, I mean, this is going to sound like I'm just, the whole death of Comex thing that I talked about, that I believe is a real risk. If I wanted to press my book, if I wanted to talk about how right I was, I'd be like, you know what? That's death of Comex right there. That's people just getting out. Everyone getting out. So hypotheticals aside, what I think aside, whenever you have open interest getting out like this, whether it's the end of the Comex or just a pause, you definitely want to say everyone's getting out for a reason. What is the reason? And, not conspiracy oriented. What is the reason? Okay, the market's not moving. It's in a range. The whole failed breakout, that was a failed fish hook. Everyone's throwing in the towel. There's a lot less resiliency. There's a lot less patience in the market. Okay, so here we go. So we have this is where we went into the upper range. We collapsed, and now we're into this range again. This sucks. This really sucks. And silver sucked more as a person who has it on. All right, so before I go to the next thing, any questions about that? About my fast forwarded explanation?
Yeah, but silver looks like it's ready to go. I mean, I know we're talking about
Yeah, but
gold
in
for
which
the most part.
yes, in which direction? We'll come to that in a
Yeah.
second. Follow? Everything
Yeah,
about
I'm
it.
with you.
We want to see it higher. I got a breakout higher. I got a signal. I bought it. For a day I was a hero, and then I fucking sucked wind. But you know, I had closed most of my gold risk. I was like hedging. I mean, I gave a lot back, don't get me wrong, but it wasn't I didn't give it all back. I made money. But the silver thing, if you look at silver on the chart, if you zoom out on the chart in silver, it looks like we're going up and we're going sideways, right? Scott,
Yeah, yeah,
Jim, right?
yep.
So up and sideways, right? So you say, oh, it's a pause to go higher. And I agree that. But if you look at the last 5 days, it's a false breakout and back in the range. So we're back in the range. The question is, will we go back? Will we re-break out higher or will we re-break out lower? I
Well,
think higher, but
Keltner bands are my new toy, and I've added those to the Bollingers, and those two are just bumping off of each other in that channel. It's
yeah,
really
I'm
it's
gonna bring
really
that
crazy.
chart up. I'll set it up. I'll bring that chart up for you so they can all see what you're talking about when we get to it. I'm gonna do that because silver is a oh my God, it hasn't been this tight ever. It's the calm before the storm, but it could be calm for a while. I mean, look, my position right now is butterflies, not in silver. In gold, I have butterflies on. All right, so here we go. Change on the week, up day normal, down day normal, up day trend day, closed futures, blah, 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 down day trend day. So this is the trend day, these 2 days together, right? Day 6, down day normal, up day normal variation, running profile. These are just words I say to myself, right? Down day normal. Okay, fine. So we went through that. Let's go through. I wish it was a little bit bigger. Can I make it bigger? There you go. All right. So here's the open interest. I want to ignore the options. I mean, I ignore the options for this. This is just about the futures, but the futures trades, I think, tell a bigger difference. You have a week. This is going to explain the behavior. You have a week that started unchanged, right? Went higher and basically went back to unchanged. That's the week. So on a week like that, normally you would expect, we know what happened. We just described it. Normally you would expect the funds to be getting in, longs getting in, which it started the week that way. And then you would expect the funds to be getting out, which it also did that. But in between, you had all this short covering. You had funds getting in, short covering rally, funds getting out, short covering rally, funds getting out. Like it was choppy. That's the word to describe it. Okay, so with that in mind, when you see a week that finishes unchanged but has a move in one direction or the other, in this case it was up and then back to unchanged, you want to look at who the strong hands made money, the weak hands lost money, which is the way it always is. But in this instance, it should be the banks making money. Whenever the banks are selling in a rally and it finishes unchanged, then assume that they scaled up. When there's no trend, the banks make money. So what did the banks do in the week? They increased shorts by 7,400. What did the short funds do on the week? Well, you've got 5,000 covered here, 9,000 covered there. So that's 14,000 shorts covered in the rally. This is just futures, right? And who did they buy from? They bought from these guys. But that's 9 and 5 is 14, right? That's 14. Call that 7. That's 7. So where's the other 7? They sold. Long sold in the rally. Oh, producers sold. They added. They traded like these guys did. Right? They traded on the same side. If they trade on the same side, that means the banks probably have producer selling. When they trade on the same side on an unchanged week, producer selling. Just looking at this. Then you have the end users. They sold in the rally. That's good. And then you have these guys. And these guys don't make sense. Because this is buying by bank longs. Think about that. All right. So let's go to the next chart. This is what I did to make sense of this. All right. Is it blue or green? Oh, it's blue. I had these glasses on when I did it. All right, so here we go. Blue are people that bought, not they made money or lost money. They just bought. Red are people that sold. Okay? So when you look at it that way, you see that now you say, well, who bought, who sold? Ready? End users sold longs in the rally, right? The market's rallying and then goes back to unchanged. They could have sold in the weakness, but I want to assume that they're making money. Sold longs in the rally, right? Shorts sold, added shorts in there. Producers and end users both sold the rally. The smartest longs sold, theoretically the smartest longs, and the smartest shorts sold, right? Then you go here and you say, who else sold? Well, short swap dealers added in the rally. That's their job, and they're doing it. They're functioning it. Who else sold? Managed money sold in the rally. Well, they probably also sold in the sell-off. Remember that day that they all puked? Open interest came in. Uh, who else sold? These longs sold. So if I want to paint a picture, I can make whoever's smart here and whoever's stupid. I can say, oh, these guys chased it and they lost money. And these guys scale up, sold it, right? Short funds lost money, long funds made money. It could be the other way around. It's an unchanged week. The long funds could have, the short funds could have covered in the morning, the first half of the week, and the long funds could have sold in the last half of the week. So I want you to assume here that in an unchanged week, everyone loses money on the fund side. So shorts covered on the highs, long sold on the lows. Shorts covered on the highs, long sold on the lows. Shorts added on the highs. They didn't sell on the lows. Shorts added on the highs. They didn't sell on the lows. You can assume these guys are smart or stupid. It doesn't matter. They sold it, right? So sold it. Anyone who bought it this week sold. Anyone who sold this week, anyone who bought this week lost money. Anyone who sold this week probably lost money.
Vince,
This is the problem. Yeah.
could I add another layer to it? So
Yeah, please,
potentially, yeah, just potentially. So this coincides with the option expiration,
Exactly.
and potentially these guys, the producers presumably short calls, and the swap dealers are presumably short calls to specs, and they probably banged it down.
Hold on. Yeah, no, I think we're going to have to do that. We're going to have to do that this week.
Sure.
Okay. Yeah. But right now, I want to assume there's no options. When I add the options layer, I think we'll get a little more nuanced on it. So, assuming there's no options, everyone who traded futures on the fund side lost money. All futures
I agree with that.
lost money. Not necessarily their portfolio, but all their hedges or non-hedges lost money, right? So if these guys are short options, you follow me, Scott? If these guys are short calls, well, they covered their shorts and lost money, meaning but they bought their negative gamma in. If these guys are long calls, you could assume that they made money, but I'm not going to assume it. Lost money, lost money, lost money. I'm going to assume on an unchanged week, anyone who sold made money. On an unchanged week, anyone who bought lost money. So that's right.
All I was saying, without looking at the options, all I was saying is, I think you're right. You don't close a position unless you're risk managing. So you can assume both legs of the funds lost money. All I was suggesting is there might be another incentive for the producers and the swap dealers to get short. That was all. Other than supplying these guys.
Options might be the incentive, or the expiration is.
I think they tend to bang it down on expiry, and it tends to rally afterwards. And it didn't in this case particularly, but you could see these guys getting whipsawed, and the reason
I agree.
Trying to manage expiration. That
I agree.
It's just that layer, basically.
Yeah. I mean, you're talking about a lot of things that affect the dynamic. The market acts very peculiarly around expirations and options, and I think last week was an example of that, especially the last 3 days. People get chopped up by their own positions, and that's what Scott's referring to. And there's something we used to call pin risk. There's another name for it now, but basically, in this instance, the options market open interest was big. We were near a strike that was big. I believe we were near a strike that was big, 3,300, which is probably where a lot of the open interest was surrounding the Goldman exotics. Okay. Back to normal conversation. We're going to talk about that. So here's what we know about this. Generally speaking, futures trades by funds, generally speaking, lost money. Futures trades by swap dealers, generally speaking, made money. Futures trades by producers made money. Futures trades by end users, I want to say made money because they're selling in strength. I assume that these guys sell strength, right? But I might be wrong. This is the only one I'm not sure of. What the hell is going on here? And so that's why we have to bring it down to options. All right, so let me bring that up. I didn't do the work, but I have an idea of what I want to do. I'll try not to make this too option geeky, but let me take a look here. Oh, yeah. Yeah, that's big. There you go. So anyone who's not familiar, open interest on the future side came in by 10,462. But when you add options in, that's 144,000 deltas that came out. That's options deltas that closed out. Okay. So we had a big expiration. And 99,000 of it was spreading, which is options versus futures in this instance. All right, so what do you think about this? All right, first thing I want to do is I want to mark up, just bear with me. I want to mark up people who had, I want to eliminate people who had no change. Okay? Other longs, no change. They had no options to worry about. Nothing at the money. That's the key. The bigger the change, okay, I got it now. The bigger the change, like here's one for you. See this? Those guys were trading at the money options. All right? That may not mean much to you, but it means this. Whoever had a... It's not supposed to do that. Oh, it's me. Okay. Whoever has a big change had either a big loss or a big gain. All right? No change. No, I don't care. No change. I don't care. Big change. No change. I don't care. Big change. Big change. Oh, look at that. It matches up. The options gamma goes from -4 to -16. That's 12. And +3 to -13. That's 14. These guys' positions traded with each other. Nobody lost or made money over here. That's it. All right. So let me pick an example that'll make this clear. Give you a little options knowledge and how expiration affects the market. Let me pick one person, one group that I know either made money or lost money. So they bought futures, but ended up flat on the week. There you go. These guys did not make money. All right? Hear me out. Unless you don't want me to go through this, I'll make it clear. I think I will anyway. Does anybody here not know what a delta is? If you don't, throw it in the chat. All right, so I'm going to explain it quickly. and if you could just type it that you need a little bit more. A delta is the correlation that an option has with the future. In simple terms, a future has a delta of 1 or 100, as in 100%. An option has a delta of less than 1, 90, 85, 80, 75, 60, blah, 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 all the way down to 1 or 0. A 50 delta option with the market trading at 3,300 has a 50 delta. It's a half a future. So what did the market do last week? It did this. It went unchanged, up, and back to unchanged. So the market finished unchanged after a round trip. So focusing only on these guys, because this is fun. I like to mock the shorts when they lose money. Focusing only on these guys. For argument's sake, the market never went below unchanged. Here's the market. It went here, up, unchanged. Now, it did go a little bit below, but that's not the point. On the week, every futures trade that the short other reportables did was a purchase. They bought futures all week. They bought them on the way up. They drove the market higher. But even though they bought, meaning they closed 9,300 shorts, by the end of the week, what happened? Well, by the end of the week, they only closed 900 shorts. Because despite buying 9,000 futures, 9,344 futures.
Great, yourself.
Despite buying those futures, by the time the week is over, all those futures they bought are out of the money. These guys got killed. Let me clean this up.
Hey, Vince.
Yeah.
So in theory, right, let's say the swap dealers shorts and the producers shorts, let's say they're short 3,400 and 3,300 calls. And let's say they want to push the market down. Okay.
Yeah.
They have got their short positions. If they're short those calls to the street or whoever, they've got longer. So they successfully
you're talking about going expiration delta. Yeah.
through those strikes.
Oh, yeah, right.
Exactly.
What about me?
All right, so David, I'm going to mute you because I know you have some stuff going on there. Cool. All right. Yeah, Scott. I mean, that's a conversation we can have with just the options guys, but it kind of goes like this. What we know is that's why I picked the other reportable shorts, because there's no way they made money. Everything they bought was above where it closed. Bought. Even if they're buying on the way down, bought. Everything, every buy was a loser on the week for them. You follow me? They're easy to see. The banks with their swap dealers and their producers really becomes a game of poker. And I was in these games constantly in my trading career as a market maker. So when the banks this is the old days, right? When the banks were short an option, because they were always short options, in this case calls, and I was long options, the banks almost always won, because the market rallied, that was a gift for me. And because I'm a positive gamma hedger, I'm going to sell futures against my long calls. But the banks didn't cover their futures against the long calls. They let their negative gamma run. The banks didn't hedge their negative gamma. But as you went towards expiration, eventually they had to, right? Well, it's who blinked first. And invariably, I blinked first. People like me blinked first. And then the market would always collapse at the strike. It would get above the strike and then go back to the strike, sometimes below it, or it would get to the strike, go above it, and then pin the strike. But the market never really left the strike. So I don't want to be, I want to be too options oriented on this, but I don't think it's going to serve everyone right now. I just want to say this, that the, hold on. How do I close this chat? There we go. All right. So I guess the only thing I want to say is the banks here, watch. All right. So I'm just going to say the facts instead of interpreting everything. All right, here we go. The bank swap dealers that are almost always short options, they're short options, believe me. They sold futures in the rally, 7,400. But by the end of the week, their open interest had decreased by shorts. So the conclusion you can make is shorts that they had went away because of expiration. They went away. So these are options that finished slightly out of the money that went to zero. So the banks were short the 3,300 call. Why did they sell futures even though we're rallying? Because they didn't care about the gamma. They only cared about the making markets. That's how they operate in a normal market. Meanwhile, the short funds bought 4,800 contracts on the week. And by the end of the week, they finished unchanged. The pattern is this. Short managed money, I'm simplifying this. I know puts are involved, everyone, but short managed money was short the 3,300 call. Okay? Long managed money yeah. That's funny. That's funny. Okay. Short managed money bought futures against their negative gamma. They covered their shorts. Long short swap dealers sold more futures. They didn't give a shit. They really had to fix on this one. They made some money this week. Producers sold 3,000 futures in the rally. By the end of the week, their open interest came in. So if you just look at it this way, option open interest came in. Okay? End users, refiners, lost a lot of their options. That could be all their options. Like they lost over 1/3 of their options, right? Producers lost 1/9 of their options. Swap dealers have nothing on. That's interesting. That's interesting because I thought Goldman had options here. Maybe they didn't expire. Right. Swap dealers that are short. So everyone's risk went down. Risk decreased. Risk decreased. Risk did not decrease. Risk decreased. Risk decreased. I don't care about that. Down. Down. Right. Down. Nothing. And down. All right. So there's really nothing revolutionary for me to say here, except that open interest is deceptive because the options expiration, and the only thing you can conclude confidently is that open interest in the options really dropped. So type questions if you have them before I go to open interest. But Randy, see this open interest chart here? This is only futures open interest, right? I mean, I want to be obvious. I want to be clear. Right?
Say the question again.
This is only futures open interest, right?
Correct.
Okay. It's been a while since I've done this, but on this, let me go to the one where you have it broken out like on a tighter time range. See this here? See how the market does nothing? Here, from here to here. And the open interest comes in a lot. Can you tell me if the volume was big on that day? It's the last day, the very last day.
Last day? Yeah, I can get that in.
Should I look for it? Where would I look for it over here?
Nope.
You don't have to look for
I got it. I got it. No, the volume on futures was 6 677 contracts on Tuesday. Then that's ClearPoint. Okay, not Globex, but I don't think.
No, I'm talking about on the, what was the volume on the 30th?
30. No, I don't have that. Yes,
Okay,
yeah, that's
all
what it is. 677. Yeah. Just 600 contracts.
Yeah. All right. So let me, Iggy's redirecting me, and it's actually where we should go with this. All right. Before we get to the open interest charts, Iggy asks or comments that open interest dropping and big money getting out, how would a typically experienced trader interpret this versus us? Just so we can prevent the cognitive dissonance in my own head. Okay. Just walking into this market, not doing all the little bullshit that I was just going through right now, just staying with the major things here. There are two or three things that my boss, I can hear my boss saying it to me. There are two or three things that my boss would say to me. He'd say, first of all, because I'm an options guy, right? And a lot of the open interest came out on options. First of all, he'd say, okay, everyone has a clean slate. The market is free to move again. He said, however, don't expect it to move until it does, meaning expect there to be news with the move. So don't expect the market to automatically get interesting again, meaning when there's a lot of open interest in options and the options decrease and the futures as well, it's a sign of decreasing interest, decreasing open interest. And that decreasing open interest tells you that you should not be committed to the market until someone else bigger commits. Iggy? So it kind of says open options or open interest. It says there's less people that are looking at the market now because they don't have to anymore. Why am I trading gold? Because I think it's going to move. A week later, why am I trading gold? Because I have a position in it, right? So you end up being stuck, at least devoting some of your time of the day to the market because of your futures or options open interest, even if it spreads. And a lot of open interest just came off, signaling people are free to not have anything to worry about. So the market's going on vacation, so to speak. Volume on the 30th, 194,000. Okay, good. Thanks. All right. So Iggy, does that answer your question? It says to me, expect dead. If the market moves, it doesn't have to be a lot of volume. And don't be excited about another macroeconomic leg higher until you see good volume confirming the move, right? It's about volume now. Unless you get good volume confirming the move, meaning volume and new open interest, volume into open interest, then everything is noise. That's how I look at it. Yeah, no. So that's what I'm saying as a trader, right? Now you're asking me, you're actually commenting vis-a-vis abandoning Comex versus Comex normal. Yeah, well, that's my theory or my thesis or my fear or my headline, and I believe it. And how about this, Iggy? If there were no Shanghai exchange, okay? If there were no Shanghai exchange, what I said to you matters. Nobody is trading Comex because they don't care about it. Meaning they don't care about the product. They don't care about gold. Gold's boring. We don't care about it. It's like it's a Fortune 500 company. It's boring, right? So there's no movement. There's no excitement. There's no volatility in it, right? Or the market is about to have decreased open interest because there's decreased interest. All right. But when you add in, see, that's how I view the market when it does that. And that's what Comex has been doing, right? But the reason that I say Comex death is not because of that. It's because while this open interest is dropping, that open interest is going up. So when you look at the world gives a big damn about gold, but Comex doesn't. And that's my reason for that is essentially, I think I concluded that that when the LBMA had a crisis, I don't have any proof, but when the LBMA had their crisis, they didn't have the metal available. They had credit problems. The whole market was on liquidation only. And when you go into a liquidation only mode, you damage the market. Everyone gets out and they say, fuck that, I'm not coming back. I'm not coming back until I know this is over. You know, it's kind of like you stay away from it. Once bitten, twice shy. Believe me, the macro discretionary guys probably didn't want to sell in the rally. They probably wanted to buy more and run the banks in. I believe I'm holding that. No one's talking about that, and it may never ever come out. So you can't prove me right or wrong. But I've been in enough of them to tell you that that was an open interest liquidation as mandated by someone very powerful. Long story short, the exchange's credibility is damaged, even if the Shanghai exchange wasn't doing anything. And it's even worse, in my opinion, because the volume is increasing over there. So if I'm a speculator in gold and I can't do anything on the Comex, I'll go to an exchange that the CFTC is not going to influence. I'll go to an exchange that the rules aren't so draconian to protect the LBMA jerks. You know, that's where I am on that. All right. So so mostly observations, not really insights here. But this is Randy's open interest chart. So yeah, here you have gold. So much for that line, right, Randy? held
I
for dead.
think we can get a little bit lower. I think that line is at 410,000 for Friday. And I think the low on the database I have goes down to like 406. So
How far does your database go back?
when we started this whole story,
Like 22?
December of 21.
December of 21. Okay. Oh, this goes backwards. Oh, that's stupid. Right. December of 21. Right there. All right.
No, wait, wrong chart. How about, sorry about that, everybody. July of 21, I go back,
Okay.
wrong column.
So July, right there. Right?
Yep.
June, July of 21. Right there is July 1st. All right. So open interest commitments were well balanced. Right? Getting out of longs, getting into longs, getting out, getting in, and getting out. It's funny that they're so far apart, given that open interest is so low. You follow me, Randy?
You know what? You don't talk about it much, but the ratio on the COT, not on the weeklies, doesn't change much. It swings around from 3 to 6 or so every once in a while. Gets a little bit out of ranges, but the ratio. Flip over to the next tab, COT. Yeah. Okay. So then, if you look at column K, kilo, I do the ratio of the long to shorts. And this is for non-commercials, but I do it also for the commercials. The ratio doesn't, it swings, but it stays in the range. And,
Right.
you know,
It's
the
like a
same
little bit of an
players,
oscillator.
are in there day after day. That's what I think.
Right. Right. January 21, max longs. If you just sold it and went away, you'd be okay. I mean, you'd have a heart attack, but you'd survive. You'd survive. You wouldn't make money. You know what I mean? Like, where was the market there?
2,800, 28, 26, 26.
Actually, no, I'm wrong. I'm wrong. What am I sold now? I'm an idiot. No, you get killed because from here,
That
when the
means
bullion
that
banks-
means the non-commercials are maximum long there, that ratio of 9. So they're 9 times long versus short. They knew what they were doing. Gold was at 2,600. Those guys made money.
Yeah, this is the
Yeah.
macro discretionary.
Yeah.
This is non-commercial loans, right? Yeah.
Correct.
And this is them taking profits all the way up,
All the way up.
you know? Right. And who's replacing them on the long side? Not really many, not too many. All right. I don't really have anything earth shattering here. All right. So here we go. So everyone, you could see the open interest here. Yeah, I see that, Scotty. Let me address that in a second. Yeah, that's by the way, see this news item that Scotty Boy has here? Shanghai Futures Exchange offers overseas investors and brokers direct access to gold silver contracts as China pushes for pricing power over commodities. I rest my case. You know what I mean? Like if Shanghai wasn't doing that, then I'd say open interest is down, wait for the market to move. Shanghai's doing that. They want pricing power. I mean, this is something we talked about for years here, and that is if you want to knock a leg out of the dollar's global dominance, you do that by getting commodities to be priced in your currency. You will see over the next year or two, you will see a ticker on CNBC pricing gold in another commodity in another currency. This is the beginning of the end of dollar dominance. I mean, dollar's not going to go away, but yeah, it's really good. I'm gonna click on this link, right? Oh, this is Kiko, right? Of course. Of course it's Kiko. I was a ghostwriter for them for a while, by the way. Ernest is good. He's good. I like him. They got some good writers again, finally. Exchange overseas investor brokers, to gold, silver contracts. Yeah, exactly. They're pushing into the market. Death of the Comex. Yeah, let me so there you go, Iggy. That's the next part of the answer. The next part of the answer is the Comex is dying. Right? Let me put the link to that story in here so I can get it later on. There we go. All right. So that's it. Thank you, Scotty. So there you have it. Shanghai is going after market share. It's a land grab. It's like anything else. The neighborhood is run down. You build a new mall next door, right? Or in a nice neighborhood, and then you tell all the customers that went to the old mall, you should come here now. And that's it. It's a real estate play. It's a land grab. All right, so there's the open interest dropping. There's the open interest dropping on a closer thing. I wish I could give you some major insight here, but I'm not. This is dropping too much compared to the movement in the market, which says to me, the only directional comment I'd say is the market can be pushed one way or another on light volume now, okay? The market can be pushed one way or another on light volume currently during U.S. hours. It's almost like the U.S. is becoming what the Shanghai used to be, and the Shanghai is becoming what the U.S. was. So as Shanghai picks up market share and volumes, the U.S. becomes the tail. And there's this is Randy's going, oh yeah, this must be it. Going back to July of 21, right, Randy? Right there.
Where are you looking at?
I'm looking at your deepest chart.
Yeah.
July of 21 all the way back here. Yeah. So this is it.
Yeah,
This
they
is
were
all you've ever had it.
they were smart buyers. They were smart buyers down there.
Yeah. So check this out, guys, to give you an idea how far we've come. Famous last words, but I just want to look at this. Open interest was here and the market was here. Open interest is back where it was and we're here. I mean, that's it. That's the complete cycle. Open interest is essentially where it was, and the market is
40% higher, 50% higher.
This is probably what? This is probably like in futures, probably like 2000. Let me see. Yeah, this is like 2000, 2100. Yeah. So like you said, call it 190 to 315. So what's that? 15, 25, 25 over 190. Yeah, 15%. Is that what you just said, basically?
Yeah.
Yeah, that's well, it's huge.
Hey, something else that I saw. Remember our 10,000 and 20,000 contract days.
10,000 was our number, then you identified the 20,000 ones, and we started to
Right.
shit ourselves. Yeah.
We haven't seen a 20 since April 8th. Given all the dynamics that have been going on here, we have not seen a 20,000 contract day since which was the day before Trump tariff 2, April 9th.
You haven't.
Where is that one?
Yeah, look at that. This is Trump tariff 2, this day here.
Let me see.
Can you see what I'm looking at?
No, you don't go to tab 4.2. Yeah, that one. Yep.
Right. Right.
And then, the scale is 10,000 to 30, but we've got nothing. They've all been below 10,000 since then.
Right. All right. So I don't really have a lot more to add. I just want to say that if you want to just take some inventory of where we are, where we were, we're 30% higher than we were, and the open interest is where it was. So the open interest is where it was, and the market is hundreds, thousands of dollars higher, $1,000, like, $1,200, $1,300 higher. And so the bull in me says the market is ready to have new open interest and rally again. The bear in me, or the alert person, not the bear. I'm not bearish. Maybe I should be. The alert person says, hey, theoretically, if gold were to go back to the way it was, this market can go back down to that price, down to whatever it was here before it rallied, and without the open interest changing. So, but that doesn't hold water because there is open interest, and it's longs getting in China. That's it. There's really not a lot for me to say. You guys want to talk about anything? It's really not or pull a couple of charts up. Anything catch your eye or ear?
I think we were
Oh,
going
I
to
know.
touch on silver.
That's right, Jim. I wanted to bring that up. That's right. I wanted to bring up let me bring the chart up.
Vince, just before we leave gold, in Shanghai, it looks like the locals buy on the open, and someone's been selling about an hour later, and looks like quite big size the last few days.
Yeah.
Have you got any?
Yeah.
Have you got any insight on that?
No, but I will suspect that I'll start with the real simple not thesis, but the real simple observation that, how do I get this to go back to what it was? Oh, there it is. With the real simple observation is that, number one, the banks aren't out of business. Number two, they need to make markets where the volume is. Market makers go to where the interest is, and the interest is on Shanghai. So it's quite possible, I'm not married to this, but it's quite possible that after the Shanghai buying is done and then it gets sold off, that's classic bank behavior, classic market making bank behavior, meaning in the US, retail or CTAs would buy and the banks would back off, let them buy it at higher prices. And then when they were done, they would see that they were done. You literally would see the orders trickle down to zero. And they also had analysis telling them that there's this much money available. When they were done, the banks would lean on it and push it down. So you could be seeing, Scott, that behavior that dominates the market-making dominated Comex moving over to Shanghai. Now, am I trying to depress you and say that's the end of it? No, I am saying that if I'm right, and the banks are now making markets over there more, then number one, we got to see the Shanghai open interest. And I know that they're doing it because that Goldman report I sent you guys about a month ago, a little less than a month ago, talking about the Shanghai open interest. If they're talking about the Shanghai open interest, then they're in the Shanghai open interest. They're not just observing it, they're international and they're making markets there. So I believe that while China has extended its influence to the US in terms of gold pricing, the US is now extending its influence to market making in China. So am I married to that? No. But I would be shocked. Look, as a market maker, Scott, as a market maker, I want to go where people care. You know, when the Dubai exchange opened up and I was still making markets, 2011, 2012, I called them up. I said, "Do you have a market maker program? I want to make markets there because that's where the flows are." And what I was thinking, like any good market maker, was if I'm in two time zones, then I could get the original flow over there. Origin flow is the key to surviving as a market maker. I want to have the fresh order flow, not the order flow that's derivative of it. You know, I want to have the guy who's betting on the Cowboys first, not the guy who's betting the over under on the Cowboys. So I wanted that. Where's the original flow in Dubai? I'll take it there and I'll hedge it on Comex. So you start trading on the exchange that has the most volume and hedging on the exchanges that have the least volume. Now, the point is, when I tried to do that then, they had no volume and they had no market making program. They didn't have a market making program, which means they didn't have any interest in developing it yet. They probably do now. So I guess what I'm saying is, if the Comex volume and open interest are dropping, as they are, and we're seeing things like this, Shanghai recruiting business, well, I'm a bank market maker, I'm over there. So I would say to you that the behavior in Shanghai, in this little microcosm you described, and this is important for our market, it's not just about Scott's question. It's a microcosm of how the US operates. At 9:30, the US stock market opens and everybody buys. And then after it's sold, it gets hit down. And then you determine if there's more buying. If there's more buying, then it goes back up. If not, it keeps going down. So the order flow gets built up. And the order flow in Shanghai is getting built up. And if I know that all the fresh order flow is being built up, it's like two nightclubs. The US is a nightclub, Comex is a nightclub, and Shanghai is a nightclub. And I'm the market maker looking at both nightclubs. One has a line outside waiting for the doors to open, and the other's got no one. Okay? So I want to be in that club when it opens so I can sell drinks to them at $10 a drink. And then I run over to the other club and I buy them for $3 and I cover my shorts on the new exchange. So I what I'm saying is that there's a really big self-reinforcing virtuous cycle over in Shanghai now, and it's the opposite in the US. And that is, if you have origin order flow and they're making money, then you will attract more order flow. And so you use that to market to get even more order flow. And if you're doing this, you're also saying to the West, bring your market making option, not option, bring your market making futures operations, bring me your bank dealers and operate over there. The Comex gets abandoned while the Shanghai grows. So it really is going to shit. I mean, this is, can it be reversed? Yeah, but I really think it is going to shit. And something I said, I'm going down a rabbit hole here, but something I said when I was talking about, the first time I talked about death of Comex, I said, what did I say? I had an explanation for it. Well, anyway, I can't remember what it was, but I had like I had a long oral presentation, and I had like these cool graphics that I had ChatGPT make for me, and about the Comex dying and all that shit. Well, you know what? It's happening. It's happening. The question is, why is it happening? And one of the things I said back then was the US doesn't care about the futures exchange anymore because the futures exchange faces outward and we only are at risk of losing more metal. But GLD is domestic. So we're going to protect the futures exchanges are going to die because everyone's going to have, I believe, the West is going to have stable coins to replace the futures. And GLD as well. But that's it. I mean, I'm probably talking too much about it, but that's it. All right. Unless somebody has something to ask or say, I'm gonna wrap it up. Oh, I'm sorry, James. I owe you silver, right? I'm gonna come back to silver.
Well,
Right?
I've already made a commitment. I bought some options out in August, so I think it's going to go up. But that's just, you
Of
know,
course. So do I, and so do I, and so do I. Like you bought options, August option. That's good. Okay, so all right. Okay, so if you look at this is my point about the whole.
and they're really cheap,
About,
by the way. I forget what I paid for it, but they're I would say it was $1.50.
no, the silver options are really cheap right now, and in fact, open interest and Randy alerted me to this. Open interest in silver futures is going up, while open interest in gold futures is going down. So aside from the whole big picture, it's the end of the world for Comex thing. There's more interest in silver than gold right now, right? So that could be a false alarm, but it's an early sign that people are looking at silver again. And I want to draw your attention to something that happened in 22. And draw your attention to something that happened in 22 and why the opposite can happen now. I'm not predicting this. But in 22, so those of you not familiar, the war started, right? February of 22, the war started. And gold ramped, but silver went up as well. Right here. Okay. And then Powell started to finally fight inflation. And that was announced somewhere in here. We got a dip. Then we re-rallied. And then the rate hike started, I think, in April of 22. And we went down. This is weekly, right? We went down all the way through here. This is where the physical buying came in. Started right here. A new bottom in October. And then buy season started. India bought all this down here while Russia and China were buying gold. India was buying silver. And the reason I'm bringing this up is because this whole phenomena of the Fed hiking rates to keep a little on a lot of things, but precious metals primarily, the opposite could happen in silver now. Okay, so here's a bullish scenario for you that I think is very possible. Right now, in this area, forgetting this whole crazy stuff that happened here, right? But in this area, call this value. This is a market that industrial demand has dropped significantly over the last, I mean, that's what everyone's telling me, over the last 3 months. You could see with the Chinese solar panels, no one's buying them, the US isn't buying them, so basically China's in a deflationary cycle. They don't need to buy silver. There's not a lot of industrial demand in silver. And yet silver lingers. So while everyone's out there saying silver's too cheap relative to gold, I'm saying, you know what? Silver's holding its own despite half of its demand gone. There's no industrial demand right now. That's what people are saying. So this was the economy getting ready for a recession. What happens if Trump tariffs go away? There are no tax cuts. And the things that I said on the HeartNet show happen. Well, industrial demand could come back. If there's peace, industrial demand comes back. And I think the next leg could really be silver. I don't have anything on except for those short dated calls that I have. But so I think sometime between silver and gold usually make a high between now. Silver and gold actually do well in the summer, and they make a high and they top out in August. That's the cyclical seasonality of it. But I think we can have a nice buy season for silver. That's it. That's all I'm saying. Nothing really crazy to add there. But I'm glad you're in, Scott. I mean, James. I'm probably going to buy some deferred call spreads this time. But by
Yeah,
the way, if you're
I-
thinking about silver, options volatility is really cheap, and that's because the banks have been selling silver options to buy gold options, and now they're out of everything. So everything's kind of dead in the water.
Yeah, I think the last price I had on Friday is $1.31 for 30-50 calls. And gold's at 30 now. So I mean if it moves 50 cents, uh, you know, you're in the
You talking
money.
about SLV?
Yeah, SLV,
SLV, right?
sorry, SLV.
That's all right. I'm typing in to see
That's
if I
what
can.
that's 1.5%. That's probably a gimme.
Yeah, I was like, this is stupid. It could move that much in a week, you know?
Yeah, it could.
I mean, I probably ought to buy a lot more. I'd only put a little bit on, but
30 and a half calls for $1. Is that what you said?
$1.31.
Yeah, that's I agree. This is the risk reward. How about this? One of the things you hear out of the banks when they have an idea is they always start out with the risk reward is compelling. The risk reward is asymmetric. That's a Hartnett phrase, or Goldman will say that. And when they say that, it's because they've already identified the thing that'll make them go. So if Goldman ever says, or any bank ever says, silver's risk reward is asymmetric, then it's time to buy call. So if they say it, Jim, I'll tell you. I'll let you know. I'll be like, Jim, they just
Thanks.
said it. I'm gonna go buy some. I'll be buying some I'll be probably buying it from you. You know, I'll be probably panicking to get it. But yeah, this is it. I mean, Bank of
I don't-
America, I didn't see the report yet, but Bank of America just put out a report saying gold to 4,000. We're all spoiled by that now. But they said silver to $40 before gold to 4,000. So I'm
Yeah,
gonna see if
I
I
don't
can
think
dig
I
that
trade
report
in
up.
the same volume you do. I don't have that much on.
I'm
You
sure,
probably
you know what?
swamped
It's
me.
all relative. It's all relative. As a percentage of your net worth, it is what it is. 5,000 contracts by Bill Gates is nothing compared to our 5 lot trades,
Yeah.
as a percentage of our net worth. Yeah, that's it. It's all relative. All right. So, uh, anyone have any words of advice, comments, observations?
Yeah, silver's gonna do something. Were you gonna show the Bollinger and Keltner bands? If
Oh
not, I can
shit.
pull it.
Yeah, that's right. That's right. Let me do that. Where's my thing to share? What happened to my tool?
I may be able to get it up and send you a screenshot real quick.
No, don't do that. Don't do that. It's just a hassle. That's a hassle. I'll get it for you.
But I mean, it
Share.
looks like something's gonna blow. I mean, they're just right in there together.
Well, that's why I brought up the risk reward thing. Hold on. I'm gonna put a fine point on this. All right. As you can see, I was looking at silver
Yeah.
on this parameter. All right, so here's daily silver. I'm going to get rid of this. We don't need this right now. This is easier to look at. All right, so silver is it's like they know. Silver is, come here. Silver is very tight, right? And it's tight for a protracted period. And you would look at that, and I'm not throwing water on your idea, James. I'm just cautioning to be patient. You may have to roll one, is what I'm saying. You're looking at the market going sideways, and you say, hey, this looks like it's going to move, which is true. The more refined way to look at it is the risk reward is asymmetrical, which you identified. Now the question is, what is the catalyst to make it move? Now, looking at my system, which is actually Randy does something very similar to me, is this market wants to break out. It gave me my breakout. Be quiet. It gave me my breakout, and then and the next I was like, this is great. And then of course this happened. And that was it. It's over, right? Okay, so now we're back in the range, but now we're in a range. I don't have the Keltner set up. I'm not going to put them up right now, but here's the Bollinger Bands.
It's
So
almost
if you want
identical right now. It's almost
I'm sorry?
identical. It's almost identical. The Keltners, they
Right.
are on both just right in
The
there.
Keltners and the Bollinger Bands are doing the same thing right now. That's how tight it is. Right. So you can make the case, and it would be, you don't need Bollinger Bands to tell you this. This is selling, and above this, the market should have some room to run. Now, in the past, I've looked at things like measured moves. This isn't a measured move because there's a level above it. If there was no level above it over the last like 50 days, then I'd say you could have this dip, recovery, and run. But I will say that above this, I'll probably buy calls again. So I'm going to either buy very short dated calls above this again, or I'm going to buy longer dated call spreads between August and December. That's it. Come here. You're bad. Come here. Give me, you know what? I'm going to give this dog a treat and then I'll come back. Give me a second. You're so. All right, guys. I fed them an early breakfast. I have to feed them an early dinner. Wait, there's a message here. Who's it from? I want a Bollinger trademark. Yeah, I know. Okay, so Randy made a comment to me just now that I want to elaborate on. It's actually a pretty good comment. Historically, when I get a fake breakout higher, okay, for Bollinger Bands, when I get a fake breakout higher, which I got, the market should reject it immediately and go the other way. It should just fucking puke, and it hasn't puked. So the fact that I got a fake breakout and we didn't go the other way implies that this market really does have a buyer, you know? So maybe we should be looking at something like a 50-day moving average. See this? Here, this will be good help for us. So Randy's point was when you get the Bollinger Band fake out above, you look for a fake out below before we go back up. But we're still hugging the top quadrant of that, or top half of that. All right, so here's something for you. Depending on how patient you are. See these moving averages? That's 50, 100, 200. Keep your eye on this. If the 50-day crosses under the 100, then you're not bullish. If it crosses the under 100, but the 100-day turn stays positive, and then this crosses back up, then that's a sign to be off to the races. I'm not predicting it, but look at this. Green, red. It's like a traffic signal. Green, red, red, green, red. I mean, this is a market that's going nowhere. Maybe we need to go nowhere for a while. Maybe selling volatility at 15% is really good in a market that's moving 50%. Who the hell knows? Anyway, that's it. So, well, they can't all be. I'm going to stop recording here.